I'm Professor Helena Barnard, the Director of the doctoral program here at GIBS. My own research is on basically how knowledge moves between more and less developed contexts, but a lot of that is in international business and specifically emerging market multinationals. An emerging market multinational can choose to go to a country that is at a higher level of economic development or at a lower level of development. This actually makes a huge difference. High-income countries have higher incomes, but it's not all good because it tends to have higher incomes because there's more economic activity, and that means more competition. There's also typically more stringent regulation, although governments tend to be a bit more efficient in terms of helping firms to get established. In contrast, low-income economies tend to have people with less spending power, but by the same token, there's less competition. The regulations are not quite as stringent, but governments are often inefficient. So it's not possible to say that there's a good place or a bad place to which to internationalize, and firms need to decide which one of the two is most appropriate when they go international. When we talk, we tend to divide the world into two. We talk about the high or the low income countries, the global north or the global south, developed, developing, advanced multinationals, emerging multinationals. But any manager from a South African firm can tell you the world is more complex than that. In fact, we can divide the world three-way, and South African firms find themselves in the middle of a global hierarchy. South African firms, when they internationalize, can choose to go upstream or downstream. In fact, what we call emerging market multinationals almost always come from middle-income countries, whether it's Brazil or Turkey, Malaysia, Thailand. And all of these firms need to decide whether they're going to go to more or less developed countries. We know from a lot of previous research that firms would strongly prefer to go to countries that are as similar as possible to what they are. Similar language and culture, not too far geographically, not too far different in terms of level of development. In the South African case, that basically means Namibia and Botswana. But those are not big markets. And very soon, firms have to decide, are they going to go to wider Africa, or are they going to go to Europe or North America or Australia? And this decision has fundamental implications in terms of the strategy of the firm and the kind of firm that's typically most successful. There are four generic strategies that we see firms following. The first one is called the local optimizer. Local optimizers is the bulk of firms from South Africa going into wider Africa. Standard Bank, Shoprite, MTN. These are South African firms who choose to rather go to the relatively less developed markets elsewhere in Africa. There's a good reason for doing that. The liability of foreigners has been well documented for many decades now. And simply put, it means that as a foreign firm, you are at a disadvantage when you enter a new country. You're a newcomer. You don't know the people there. You don't know the rules and regulations. You don't know which rules are on the books, but nobody really enforces them, versus rules that you absolutely have to follow. There are also things like working across different currencies, different cultures, and a whole range of complications. So for firms to choose to go international and at the same time go into a more competitive and a typically more demanding environment is looking for trouble, quite frankly. So very often, South African firms will choose to internationalize into the relatively less developed market in the rest of Africa. The next strategy is that of the global consolidator. And these are firms that, in a sense, have outgrown the local context. The best example here is probably South African breweries. South African breweries started off as the brewer of Africa. And then it started expanding into other low-income countries and eventually to other middle-income countries, for example, in Central and Eastern Europe, before it acquired Miller and became SABMiller. Itself has now been acquired, but it's interesting that its acquiring firm had a very similar trajectory, starting in Brazil and ending in Belgium. And if we look at Steinhoff, we see that it's probably following a similar global consolidation pattern. What happens in this case is that firms use the learnings that they've developed in a lower income market to help them to springboard into a higher developed economy. A lot of these skills are generic skills about managing the complexity that comes from multiple currencies, multiple legal frameworks, multiple cultures. And what we see is that to some extent, the learnings in a very different context, the African context, do carry over into a context like, for example, Europe or North America. The third generic strategy is that of the broker. Broker firms help interpret the high-income countries and the low-income countries to each other. If we think about Barloworld is an excellent example. It sells a number of brands, let's take Caterpillar as an example, into locations where Caterpillar probably doesn't feel comfortable entering. In many ways, it acts like a regional headquarters for the high-income countries' multinational. But they have very different capabilities. Barloworld has seen an entrepreneurial opportunity in terms of the sales, the distribution, and the service of equipment that itself probably could not design and manufacture. By positioning itself as an interpreter of these two very different worlds, it fills a hole that otherwise would be left. It's also important to note that brokers need not be multinationals as we understand it. A few years ago, an MBA student of mine, Joel Rosen, did his research about international housing solutions, and we've just published a chapter on that. International housing solutions basically operate by connecting socially responsible investors from North America and Europe who are looking for an investment that is socially responsible but with a good return with housing developers in first South Africa and now beyond South Africa. Through this brokerage activity, a very small firm with less than 40 employees was responsible for tens of thousands of housing units. So the broker firm really can see a gap and operate, even if it doesn't operate at the scale of a multinational. The final category is that of the specialized niche provider. A specialist niche provider is almost by definition a fairly small firm. In South Africa, we think of Derivco, a global leader in online gaming and one of the largest employers of software developers in South Africa. Environmental Solutions is a company that monitors forests for fire and increasingly also harbors to see if there's any criminal activity. It beat NASA and attended to safeguard the Canadian forests, operating primarily out of Durban. And Ideco is a company that works in biotech, working with biometric solutions in the IT space. What do these companies have in common? Firstly, they're innovators. They tend to operate in a very focused, narrow niche area where they are doing such novel work that the novelty itself almost protects them against the highly competitive markets of the high-income countries. Secondly, their workforce is highly skilled. In fact, if we were to compare the workforce of one of these firms, it would with the workforce of other firms in South Africa, it actually looks more like a firm that could have been originating from a high-income country. And this is important because this is where their markets are. And in terms of the skills base of their employees, they go straight into the high-income countries, but in a very small scale. And linked to that, they cannot really grow that fast because they are constrained by the number of skilled people who can work for them. In a middle-income country, it's just that much harder to find enough skilled people to really be able to operate at a very large scale. For this reason, the specialized niche providers that go straight into the high-income countries tend to be quite small but very innovative. So we've got 4 generic strategies of how a firm in a middle-income country makes sense of its position in the middle of the global economic hierarchy. They can be local optimizers, going downstream and exploiting a relative competence relative to the local economy. They can then springboard into high-income countries using their experience in the lower-income countries to help them succeed in the more competitive high-income countries. They can be brokers that help high and low-income countries talk to each other. or they can operate straight into high-income countries, provided that they're very innovative and often quite specialized in terms of the offering they provide. So how does this help a manager? First of all, it must be said there are other strategies for internationalizing as well. If you're in an extractive industry, you simply go where the resources can be found. We are also seeing the emergence of a follow the expat strategy. In the case of Nando's, they used the presence of a sizable South African expat community to get a critical mass of consumers before going to a location. But we are also seeing firms that choose to work with a trusted and skilled expat in a different location to help them start up their operations over there. But this model still helps managers to think through the risks and opportunities of countries at different levels of development. It's a lot of money to internationalize, and firms often find themselves knee-deep in internationalization problems if they haven't thought through the consequences of their actions. Hopefully, this model can help provide a structure for thinking through the consequences of certain internationalization decisions.